Thank you for that, James. Good morning, all. I'm Jean-Hugues Delamaz. I'm the portfolio manager for Ecofin Global Utilities and Infrastructure Trust. For those who don't know us, Ecofin, we've been around for something like 30 years, working as specialist asset managers on the concept of ecology and finance, as indicated by our name. So we very much specialize in infrastructure, utilities, and energy transition thematics. That's all what we do. And we invest in listed infrastructure in the strategy we're going to talk about today. In contrast with some of the speakers this morning, we focus on the listed side of infrastructure. So maybe, James, we can start with page 3, or the next page, sorry. That's 42 for you. Yeah, that's an overview of the strategy. We'll move into more details in a minute, but I think it may be useful to present a snapshot of what the trust does. It's a global strategy. We invest worldwide with a balance between North America and UK, Europe, and a cap on emerging markets. We've capped our exposure to emerging markets at 10%. What we aim at is at generating a combination of capital preservation and exposure to global growth. Capital preservation, we express it in the form of dividend yield. We produce an income of around 4% on NAV. That gives obviously some stability to our investments, but we also want exposure to growth. Growth-oriented economic infrastructure, which we estimate in our portfolio is bound to grow by 5 to 7% per annum. So if you put those two on top of one another, dividend yield of around 4, growing at 5 to 7% per annum, you more or less reach double-digit per annum. We have an official target of total returns of 6 to 12% per annum. Interestingly, we've generated just above 12% per annum over the past 5 years. And our shareholders have actually generated higher returns than that because our share price has been up by more than 17% per annum since September 2016, which is the inception of the trust. So that's for the very broad picture. Where do we invest? The way we define economic infrastructure is through 3 subsegments. Electric and gas utilities, so quite a traditional segment, but that includes obviously growing proportion of renewable energy. Secondly, environmental services, and thirdly, transportation infrastructure. That's how we define economic infrastructure in EGL, so Ecofin Global Utilities Infrastructure Trust. Next page, if you could move, James. I'm going to explain in the next few slides just our investment philosophy. I think it's important to start with that. Then we'll move into the opportunity, where we see the opportunity to invest in the space, and I'll finish by giving you a few indications of valuation ratings as we perceive them. So first of all, our investment philosophy. Very general, we're looking for companies which are asset-backed services based on long-term contracts. Those long-term contracts provide high levels of predictability of the future cash flows. And thanks to those predictable cash flows, we can identify the companies which produce a sustainable and growing dividend. So these are the very basic 3 criteria that we aim at identifying in our investment universe. Next page, we are digging a little bit further into our investment philosophy. Yes, this one, thank you. We very much aim at identifying the value from the energy transition. That's at the core of our strategy, and I think it does represent a specificity of this trust. We have a very much a total return mindset. I kind of alluded to it. So looking for regulated or contracted cash flows, looking for above average growth profiles. And probably what is very significant to highlight is that rather than any kind of cyclicality, we're very much looking to identify the structural growth opportunities that emerge from the energy transition phenomenon, such as obviously the shift to renewable energy. And one last aspect I'd like to highlight, again, I think it's quite specific, talking about how we use ESG, how we read into it and apply it to our portfolio construction. A lot of the pure impact strategies would only focus on, for example, among utilities, the clean power generators. We do obviously include some of those in our portfolio, but what we also allow to ourselves to do is identify those companies which are not yet clean, but are transitioning to a decarbonized and more electrified business mix. The direction of travel is for us a key factor to identify the winning stocks. We're looking for companies which either go through a drastic and immediate strategic shift through M&A or spin-offs. We have quite a few. A very illustrative example is the case of RWE, the German utility major, which until 3 years ago was 90% exposed to coal power generation and has now become, through an asset swap with E.ON, its main competitor, 2/3 exposed to wind and solar, with significant implications for its growth profile and potential for higher returns and valuation, as I'll show you in a few minutes. So either drastic transformation deals or more gradual processes, strategic processes for companies like Nextera in the US or closer to us, Enel, Iberdrola, Drax as well, obviously. So direction of travel is a key aspect of our investment philosophy, as opposed probably to purer impact-focused strategies. So that broadens the scope for identifying future winning stocks. And the next page, that's going to be the last one on investment philosophy, is very much how we use ESG, the theme of today's webinar. So for us, I think I already kind of alluded to it, ESG is not a way to exclude stocks ex ante. We have very limited exclusion criteria. We use ESG as a positive selection tool. How do we do that? As I mentioned, we're looking for the direction of travel. So we go through our own proprietary kind of customized assessment of the capital allocation, how it evolves, how we are expecting it to evolve going forward. So it's a forward-looking view, much more than static. And that leads to a positive selection of the companies with the highest rate of improvement going forward. There's a second way we use ESG, which is to avoid the major pitfalls. It's for us an interesting risk management tool. I like to mention the example of PG&E, the Californian utility. You have a chart on the right-hand side of the slide. PG&E back in late 2017 was very much a stock in favor. A lot of analysts were recommending it. It was a pretty solid regulatory framework, potential for growth, transition to a cleaner energy, lots of potential. The way we avoided getting exposed to PG&E was very much going through a deep analysis of its environmental exposure. I would say out of the ESG letters, we have a focus on E, particularly at Ecofin, and that has allowed us to identify the potential risks of liability that the company had to wildfire in California. That, at the end of 2017, we started to see the first ones. That gave us a clear indicator that there was a stock to avoid. And as I'm sure you're familiar, the company ended up going bankrupt. A couple of years later, I think ESG in that particular case definitely allowed us to identify the potential environmental risks attached to the story. Now, that's about our investment philosophy. And in the next few slides, I'd like to talk about what we see as a compelling opportunity to invest in the space and the strategy and the trust. And it's going to be a threefold opportunity. It's a question of accelerating growth, enhanced returns, and inflation protection. So first of all, accelerating growth. On this slide, I guess you're going to see data you must be very familiar with. So I'll be quick on that. The world currently invests about $2.5 trillion per annum in economic infrastructure. That's worldwide. To reach the United Nations goals by notably 2050, so net carbon neutrality by then, you need close to twice that figure on an annual basis. Where we like that CapEx requirement and CapEx phase is because it's supported by a very strong political drive. More than 70% of the global GDP is now committed to full decarbonization, as we know, including China. That we believe represents kind of an assurance that CapEx will be remunerated in a proper way. But growth, more specifically to what we do, the next page, is about the switch towards renewable energy. And that's something which sometimes tends to be overlooked, but companies that, like RWE, as I mentioned, which switch out of coal into renewable energy, actually increase dramatically their exposure to growth segments. As you see on the chart on the left-hand side of the slide, this is based on BNEF data and outlook. As you can see, if you look at coal, it's expected to gradually decline in the next decade. The COP26 kind of has confirmed that trend. Natural gas may increase marginally, but the segment clearly which is bound to grow at double-digit per annum in the next decade is clearly wind and solar. So any company in our space which gradually is switching its strategy towards this last segment increases its growth profile. That's what we like to identify. That's very much the structural growth trends that I was indicating earlier. So decarbonization and electrification, we see those two phenomena are clearly a source of growth and secular growth for the next decade, at least, probably a couple of decades at least. With the doubling of the proportion of electricity consumption in the final use of energy consumption worldwide. So that's about the growth opportunity that we see in our space. Now, I'd like to spend a few minutes on the opportunity for enhanced returns, as I mentioned, and that's the next slide. Thank you. Enhanced returns in two ways. The first one is more sort of a shorter term opportunity, and then there's the deeper element of it, and more structural. I'll start with the most immediate. As we are all familiar, obviously, in the past year, we've seen a dramatic increase in commodity prices, which has fueled through to power prices. Roughly, power prices have doubled in the past 12 months, and that's a worldwide phenomenon, definitely across the industrialized world. What it means is that for a lot of the power generators in our utility space, as you can see on the left-hand side of the slide, you're going to have a significant positive effect on their returns, which will spread out over the next 2 or 3 years. As you can see, most of the companies have hedged their prices for this current year, 2021. But the increase in the market prices would actually fuel through to the returns of most of the power generators as of next year. So we are only starting to see the positive effects of that. But maybe more importantly, what higher commodity and power prices means is also that renewables have become much more competitive relative to other fossil fuel sources. As you see on the right-hand side of the chart, the inflation that we've seen in commodity prices has only marginally impacted the cost of electricity generated out of wind and solar. Obviously, wind and solar are not based on any commodity. I mean, wind and solar is kind of available, as opposed to coal and natural gas, which have been directly impacted by the massive rally in coal and natural gas prices worldwide. So in fact, renewables have become much more competitive, much cheaper than fossil fuels over the past few months. That is also part of what we see as a significant opportunity for enhanced returns in the space. And in the next slide, we highlight something which is probably less known, which is that there is also a structural effect of the energy transition on the business mix of the companies we invest in and on their return profile. Back about 10 years ago, those who were covering utilities are probably familiar with the fact that about half of the operating profits of a typical utility 10 years ago was based on conventional power generation, which was obviously largely driven by commodity prices. This proportion, 42% in 2008, has shrunk to something like 10% today. While if you look at a typical utility in Europe or the UK today, about 80% of the operating profits, cash flows, would be stemming from either regulated networks or contracted renewable concessions. So it's become much more predictable, much more based on fixed prices than before, and therefore much de-risked. Interesting to highlight, by the way, that this is a phenomenon that we've seen mostly in UK, Europe, where renewables already accounts for about 30% of the EBITDA of a typical utility, while in the US, that proportion is still less than 10%. And we think this is only going to grow and accelerate. Why is this so significant, important for our space? Well, notably because of what you see in the chart at the bottom, which is, as I mentioned before, what happened to RWE since the group has phased out of coal and moved into wind and solar. Of course, back in early 2018, RWE was not a bad company. It was just exposed to a declining industry of coal, and it was a cash cow with no capex, no scope for growth. And typically, the market was valuing such a business at maximum 10 times PE. With the transition, the switch to a renewable exposed mix, RWE has doubled its PE in less than 3 years. And now trading on around 20 times PE, moving from a significant discount to European utilities to now a premium. That is, we think, highly illustrative of what is happening in the utility space today, a phenomenon which is still, I think, hardly perceived by generalist investors, but definitely at the core of our strategy. That's very much, again, what I was describing before, the direction of travel that we aim at identifying in the stocks we analyze in our investment universe. And there is a last aspect of the opportunity, the next slide, very topical, which is about the inflation protection. And here also, I think it's worth spending a couple of minutes on that. Inflation protection is coming from three different phenomena in our investment universe and portfolio. The first one is that you have regulated models with almost perfect inflation indexing. You find those models particularly in the UK, also in some countries like Italy, a bit counterintuitively. So those are countries which have based their regulatory model on direct, immediate inflation indexation. So full protection for that segment, which accounts for a small third of our investment universe. Then there is a second third, which is more about pricing power. And you find this in a lot of long-term contracts, long-term concessions, which again are at the core of our investment universe and stock selection. That's typical of the non-regulated water or waste management contracts, also typical of some transportation infrastructure contracts, toll roads notably, where you have a K factor, which gives quite a strong pricing power to the operator, and where inflation is typically contractually passed through. So good inflation protection, and as you know, as you see, we've already analyzed here about 2/3 of the investment universe. And then you've got a last third with what we call a cyclical tilt, mostly including the power generators, where you have actually typically some ability to pass through inflation, less direct, but in a lot of cases actually coming through with a bit of a time delay. So overall, good levels of inflation protections in our investment universe, and obviously the diversity of the types of business models we invest in allows us to overweight one or the other of the subsegments depending on the inflation expectations that we have. And obviously, in the pure regulated space today, we very much favor those with direct inflation pass-throughs. So that was about the opportunity, the threefold opportunity: growth, enhanced returns, inflation protection. And now, if I may, I'd like to spend a few minutes on the valuation, some valuation data, and we've called this the valuation gap because we think it is pretty striking and compelling as of today. On this slide you have on the screen, that shows actually the immediate relative PE of utilities relative to the general equities market, the broader equity market. What you've noticed on this chart, what you can see is that utilities are actually roughly 15% cheaper than they were pre-COVID. We see this as an anomaly. During the period, utilities have actually been one of the most resilient segments of the economy. Stocks performed and resisted pretty well during the bulk of the crisis last year. And if you see the quality of the earnings delivery for most of the utility majors this year, both in UK, Europe, and North America, we see it as an anomaly that the space is still trading at such a discount to the general equities market. So that's the first phenomenon, a kind of a short-term opportunity here. Next page is more about the long-term perspective, and one aspect which a lot of generalist investors pay attention to, which is how do utilities typically perform in periods of steepening yield curves relative to the interest rate context. What I think is interesting to highlight is two things. First of all, on the left-hand side, you see that the spread between the dividend yields of the utilities sector versus government bond yields remains, very attractive. That's a chart since 2016 here. We could have it on a long-term basis. The spread of dividend yields that utilities and infrastructure in general offer remains pretty compelling in our view relative to government bond yields. And on the right-hand side, you even see it more clearly over a 30-year perspective. Utilities have hardly ever been cheaper relative actually to the corporate bond market. That's a chart based on US regulated utilities, again on a 30-year basis. And then you have a last aspect about the valuation gap on the next slide, which I think will speak to a lot of you in the audience today. It's what we consider as also an anomaly in terms of gap between listed and unlisted valuations of infrastructure assets. We've taken three sub-segments to illustrate our point here. We looked at airports, at water operations, and offshore wind. So three different parts of our investment universe. What we see is based on the private equity valuations and transactions that we are seeing, there's quite a lot obviously these days in our space, there is about a 40 to 50% valuation gap between equivalent assets when they are listed versus what private equity investors are ready to pay. We've highlighted in the chart about airports the latest valuation criteria used for the bid on Sydney Airport. I know airports are a difficult area to analyze these days, having lost about 90% of their revenues last year. Still, on a normalized basis, Sydney Airport is being taken out on the basis of about 25 times its EV/EBITDA. So I think this phenomenon is clearly overlooked by equity and listed investors. It's a phenomenon which will only be highlighted further by the ongoing consolidation phase we are seeing in our space. We've seen a number of transactions. I've mentioned Australia. We've seen three major infrastructure transactions in the past 6 months in Australia, a very narrow market with actually a limited and reducing number of listed entities on the Australian market. But we see that on a global basis across the infrastructure and utilities universe, some consolidation, M&A, and in most of the cases coming from private equity firms, which have a very different perspective on the valuation criteria than listed investors, it seems. So we do expect some partial closure of the valuation gap between listed and unlisted assets in the space. I think that sums it up, James. Maybe to conclude, I've added two slides. I mean, the first one is the one you're seeing here. It's the carbon performance of our portfolio. As I explained before, EGL, so Ecofin Global Utilities Infrastructure Trust, has very limited ex-ante filtration criteria. Still, the outcome, the end game, is that we end up with a pretty clean portfolio, much cleaner than the sector, much cleaner than the relevant grids. The share of coal in the electricity generation mix in our portfolio is only 10%, about half of what it is typically in utilities worldwide. And our portfolio is about 25% cleaner than the relevant grids. That's a criteria which we do track across our strategies. And the final point I wanted to make, page 16, is about, well, the next page, sorry, our performance track record. I mentioned it up front. I think interesting to highlight, again, annual NAV performance above 12% per annum over the past 5 years, 70% per annum for the share price. But you see that also in comparison with the underlying indices. Again, we have a total return mindset. We're not trying to use a benchmark, so those indices are more mentioned for reference purposes. But as you can see, we are deeply convinced that over the years, and that's a strategy, by the way, which Ecofin has been pursuing for over 15 years in the current investment trust form for the past 5, but actually on the long-term basis, we have managed to deliver double-digit total return per annum. In good and bad years, if you look at the the macro context. So we are convinced that this is the result of our focus on the energy transition and its effects with using ESG filtering positive selection tool to analyze and identify the winning stocks. That's pretty much it, James.
Thank you very much. That's interesting as always. So we've got some questions coming through already. If anybody else wants to ask them, well, just please put them into the Q&A function and I'll relay them to Jean-Yves. We're going to start off with one, because we've got the performance up here. What's been the main drivers of performance over the past year for you?
Well, it's interesting. Your question is interesting because actually in the past year, utilities and infrastructure overall have been major laggards on equity markets worldwide. While in 2020, the space was considered almost a safe haven, talking about utilities more than transportation infrastructure, of course. So therefore, relative to equity markets, utilities performed pretty well in 2020. In 21, there's been a clear reversal. The focus of the market has been about the reopening trade, with a clear focus on more cyclical parts of the economy. So utilities indices have been lagging behind, and you have the numbers in front of you. As you can see, our performance has still been pretty solid. And again, that gives us further confidence in our ability to identify the winning names. Actually, we've of our top 10 performers this year, about 7 or 8 were non-index names. So we very much pride ourselves at identifying winning stories outside the typical indices. Still in mid caps, we hardly go into small illiquid market caps. But one of our best performing names is Chinese name, China Suntian, which very much was below most of the radars about a year ago. The stock has doubled this year. So, but also if you look at a story like Drax, better known probably by our audience today, typically a non-index name, which was falling out of most of the clean energy models due to its kind of legacy coal exposure. But Drax is actually now almost 100% biomass exposed and offers dramatic scope for growth and enhanced returns. So I think that's what we can say, James, is that it's always embarrassing to say, but I really think our stock selection has been critical for performance in the past 12 months.
Good. What we have seen recently is much higher power prices. What difference has that made to the portfolio?
What? Sorry, James.
Much higher power prices we've seen over the past
yes.
Yeah, months.
So you mean what implications it has, or where it comes from?
Yeah. What did it do to the portfolio, and what do you think it has implications going forward?
Yeah. So first of all, where does it come from? So it comes from a combination of factors. Obviously, we spoke about the strength in commodity prices, which is one factor. There is a second one, which is what's happened to carbon prices, primarily in UK, Europe. The focus of most countries on decarbonization, the political drive, represents significant support for carbon prices, which are now above 60 euros per metric ton. They were half that hardly a year ago. So that has become one of the factors behind the fixation of power prices. And there's a last phenomenon, which is the scarcity of supply. As a lot of countries are phasing out of coal, also phasing out of nuclear. If you think Germany, which is about to close its last nukes in the next few months, that is creating some kind of issue of security of supply. The reserve margin in a country like the UK is less than 5%, which is a phenomenon which is year after year highlighted by the National Grid, saying, we are not very far from a risk of power cuts in some parts of the UK. We've had some a couple of years ago. The reserve margin is extremely thin. That is definitely a booster to power prices. Then the implications for our space, I think so, as I kind of mentioned before, they are twofold. First of all, for pure power generators, it's a clear booster, but much more, secondly, for renewables than for fossil fuels. I think some countries have gone back to using coal. We've seen that in Germany, against all odds. Thank God we live in a country here in the UK which has completely phased out of coal in the past decade. Who would have thought that 10 years ago, that the UK, an economy which was built around the coal mining industry as a fuel source, has completely phased out of coal in less than 10 years. But some countries like Germany or Central Europe have gone back to coal. Natural gas also has survived, although the spreads, the spark spreads, which is the margin very much you generate on natural gas, has shrunk. It's shrunk due to the cost of supply, which has gone up more than actually the power price. So what it really means for us is that wind and solar are the clear winners. No increase or very negligible increase in the cost of production. Of course, they're impacted by higher cost of steel, notably for the wind industry. But that is quite a negligible part, the cost of production. They are generating technological gains, and the higher power price for them is a way actually to sign PPAs in better conditions than before. So it fuels through to the whole value chain, particularly on the renewable side.
Okay, thank you. There are a couple of questions on the US. So one of them is just saying, what's your general thoughts on the Biden infrastructure plan? And the other one is how far along is the US on its journey towards transition to renewables, and how can it play catch up with Europe?
Yeah, interesting points. Thanks for raising them, James, or whoever asked the question. The Biden infrastructure plan, major. It's major, obviously, for the world, for the planet, for the decarbonization phenomenon, and for the infrastructure segment particularly. The direct implications for our portfolio are relatively minor, to be honest. There are limited ways to play the direct effects of the higher capex program that the Biden administration has announced. In our portfolio, we do benefit from that prospect, notably through names like Ferrovial, which is Spanish infrastructure operator with notably toll road operations in North America. I think the capex on roads, part of the Biden program, only fuels through to the potential for such a company. But it's pretty indirect, to be honest. Pure plays on the Biden infrastructure plan on the listed side are very few. So let's be honest, it's more an indirect effect than a very direct impact. Now, how are the US switching towards renewables? Ecofin is part of a US group, the Tortoise Ecofin group. So we obviously interact a lot with colleagues based there. And I think the mentality there, notably with the large oil and gas players and also utilities there, has evolved dramatically in the past couple of years, but clearly behind the phenomenon we've seen in UK, Europe, which started probably 5 to 10 years ago. It's only starting in the US. I think the Biden election is in itself a very significant transition and threshold. And we're seeing now a lot of US utilities groups focusing on renewables, on offshore wind, while frankly 2 years ago they were hardly mentioning it as part of their investment case. And as I mentioned before, last point, renewables still account for less than 10% of the cash flows of typical US utilities, which is about a third of the weight of the space for European utilities. So it's a phenomenon which is coming. We expect significant M&A in the US as the major utilities are adapting their business model, a little bit what we've seen in Europe. And I think this is bound to lead to re-rating on equity markets.
Okay. To what extent are the big utilities being proactive, do you think, in addressing climate change concerns, or just being reactive to what's going on? And then also linked to that, to what extent do you actually engage with them to try and encourage to adopt a more environmentally positive strategy?
Yeah. Well, UK and European utilities have been at the source of the energy transition. Frankly, if you look at the world leading renewable developers today, out of the top 10, you have 8 UK or European names. It's striking. I mean, the only US name in the top 10 renewable developers is NextEra. What other winning industry, growing industry in our global economy has only one leader out of the top 10, which comes from the US? It's very unusual. So the dominance of UK Europe is significant, and I think it shows that groups like Enel, Iberdrola, even EDP in Portugal, which the three of them stand among the biggest renewable developers in the world, have started their transition about 10 years ago. So ahead of the curve. So I think those companies have been proactive. Now, should we say that a lot of the others, a lot of the US and probably Asian players are more reactive? Probably, I think we can say that. If you look at, it's interesting to go through the websites of those companies sometimes, to look at the weight they are giving, allocating to United Nations goals, SDGs, temperature evolution, carbon neutral targets. We did that exercise a few months ago, and about 80% of the companies in Europe had quite a focus on it on their website. For the US utilities, it was about 40%, and frankly, in Asia, it was 20%. So that gives you an idea, and again, that was about a year ago. It's evolving fast. A lot of companies are reactive, but I think we can say that UK, European companies have been ahead of the curve. And you had the second question, James, sorry.
Just how do you actually engage with the companies to encourage them?
How do we engage? So we are not, Ecofin does not pretend to be an activist asset manager. Having said that, we do express views. The G of ESG is also obviously a key focus for us. We vote at every single of the companies we have some investment in. And we sometimes express a view. We did actually earlier this year for Coventa, notably, a US waste to energy operator, a waste management company which has transitioned towards waste to energy, which we think is a winning segment of the energy transition investment universe. Coventa has been bid for, and actually we consider at valuation levels which considerably underestimate the re-rating related to its strategic shift towards waste to energy. We have good examples with Pennon, notably in the UK. Now its waste side hasn't been taken out by KKR, but good examples of waste to energy and how it can be valued. And we think it's been clearly underestimated by the bid on Coventa. We had significant exposure to the name, and we did write to the board, and we also published through press releases our fight for this. So we do engage. We did engage in this particular case. I'm afraid the board has decided to back the offer in the end, but we continue to fight for it.
Good. There's plenty more questions, but I don't think we've run out of time, unfortunately. So thank you very much for this morning, and maybe we'll actually email you a couple of those and get you to, maybe we'll sort of write something on them afterwards.
With pleasure. You've got the contact details in front of you, Elspeth and Michael, or me, obviously. Always happy to hear your questions and help you.
Cool. Thank you.
Thanks a lot for your invitation, James. Bye-bye.
All right, so bear with me. I'm just going to switch the slides over so we can